Better you get that data than never, like you said. So keep on trying, Kyle. We know you're doing your best on that. But so close, you said, to an all-time high. That's exciting. I think we're almost there. I think maybe we'll break it at least in next week's episode,
You
if
have to
not
think.
already, by the
Yeah.
time we go live.
Yeah, we're on that trend, and it's just so close. I really can't help but feel like it's nothing up from here. So that's all fantastic. And with that, Herwig, I think let's dive into the topic for today, for the main topic, which is liquidity. And you described that there were three types of liquidity in an article that you published all the way back in January 2019. And that was titled Debunking the Myths of Liquidity, in which you argued that security tokens don't necessarily equate to liquidity. And I'd love to hear more.
Definitely, Kyle. Yeah, I definitely remember that one. Security tokens were a huge point of interest in the crypto industry back then. But the crypto industry, they thrive on liquidity with their exchanges, and many were seeing security tokens as a way, create instant liquidity for an asset or a security, which is just not the case. The reality is that digging an asset does make it a lot easier, but it certainly goes far from instant. But before I define what I call the three layers of liquidity, Kyle, I think people have a different interpretation of the term, especially all different types of listeners on the show here. So how would you define liquidity to them?
So liquidity is simply an asset's ability to be converted into cash, right? So dollars are really liquid because everyone has them, and that's really what we're talking about from a base standpoint. How quickly you can convert that into fiat currency is really how we define liquidity. So private companies, for example, are very illiquid because it's very difficult to transition that into US dollars, and really because they live in an outdated capital market infrastructure that makes it very difficult to buy or sell.
Well said. So many asset issuers were looking to security tokens to create some sort of an instant liquidity solution, which is just simply not the case. I think the term supply and demand comes to mind, with emphasis on the part of demand since the supply already existed. So creating demand is a function of many different factors, I'd say. Liquidity errs more on the combination of demand and the ease of access to the supply, I'd also say. So security tokens make it dramatically easier to implement access to the supply and to create demand via numerous mechanics. But of course, we are assuming in all of this that there's some level of value and or growth potential to the asset itself, right?
Yeah, exactly. So what are those three layers of liquidity that you're looking to describe? I mean, are there different ways to implement liquidity?
Not quite. It's actually a little bit more like about the types of liquidity channels, if you will. So there are three different types of transactions that all involve the buying and selling of a security token or an asset in general, really. So there's actually maybe a bonus fourth layer. I don't know. We don't really know where it fits, but you'll have to tell me your thoughts when we get to it, Kyle.
Yeah, absolutely. So how about you just dig right into it and break it down for our listeners?
All right, let's do it. So the first layer is the issuer itself. So the second is peer-to-peer, and the third is secondary markets. So let me explain each in a little more detail. The issuer layer I describe, as any sale with the counterparty being the original issuer of the tokens. So the issuer has more flexibility than investors, employees, or even brokers. They can offer buybacks to the purchaser, offer loans like Reno does with their real estate tokens in the first year, or they can even, offer programmatic exchange rates for perhaps different token types, meaning that, someone could go and exchange their securities for Bitcoin or US dollar tokens, or maybe another class of shares with the issuer. In essence, if you're able to buy a security token and you can always sell it back to the issuer at fair market value, then you've got yourself a pretty liquid token because you could go and sell it back to the issuer at any time, regardless of lockup periods as well, by the way.
Yeah, that's a nice touch, and it goes to show the freedom that you have as an issuer to create liquidity for your asset. And now I think we should take maybe a quick pause here and reiterate the fact that neither Herwig nor myself are securities attorneys. So definitely verify all of this with your legal counsel. But to me, it sounds like as an issuer, you have the most possibilities of creating benefits for your investors, as you said, via a loan or buyback or similar program. So I think many issuers jump to the idea that you need to immediately list on an exchange somewhere, and that's just simply not the case.
Yeah, absolutely right, Kyle. It's often not the first consideration, and I think that's because before security tokens, implementing such benefits to investors was just extremely difficult to manage. Before, it was common that maybe you might actually have penalties to redeem or sell your interest back to the issuer. So now, thanks to smart contracts, it's really easy to engage in securities transactions with your investors. So letting them stake their tokens as collateral for a loan or instantly trade them in for some US dollar coins is, actually dead simple and much cheaper to administrate. So, and that also offers us a kind of nice segue point into the second layer, which is often also considered an afterthought, I think, to investors, but it's actually a revolutionary concept, I'd say. So investors who previously held what are typically considered illiquid assets had to go through many hoops to sell it to someone else, typically sometimes requiring approval from the company and legal documents to also be drafted up. So now, thanks again to the benefits of self-custody for security tokens, they can be transferred peer-to-peer between qualified investors while updating the issuer's ownership chart automatically. So this presents two new liquidity strategies using this channel. The first is that an investor, they can now have liquidity via their own network, something that might be used as a way to recoup some of their initial investments or maybe even split the risk of the investment, or something to sell to other funds or investors in a much easier fashion. And when things become easier to do, they tend to be done more frequently. So, which leads to the second strategy, which is OTC desks, otherwise known as over-the-counter traders. So, enabling funds and asset managers and market makers to support your security token will definitely increase the access for peer-to-peer transactions because the network effect just grows a lot bigger. So, let's give an example. An investor in Kansas City lost all his money on the Super Bowl, who is now trying to sell his security tokens because he needs money to someone else in his network. But it's useless because when everyone else in his Kansas City network, they've all lost money on the Super Bowl, so no one's got any ability to buy or sell there. But if our Kansas City investor had an OTC desk, that was actively trading the stock because they are trading it across the country or via a network peer-to-peer thanks to security token technology, well, then the investor may be able to find a buyer.
A timely example, Herwig. I imagine Kansas City investors lost a lot of money over the weekend, but basically, as I see it, you're saying that illiquid securities now have less friction when performing over-the-counter or peer-to-peer trades, and therefore may now be traded more, which increases the potential demand for the asset, given that it's easier to acquire and manage your trade back.
Yeah, that's exactly right. And this works for bigger and more established security tokens, but it will start to happen more and more, and that I have no doubt about. But of course, everyone is looking at the holy grail, the third layer, the secondary market layer. Marketplaces and exchanges, they're secondary players designed to help facilitate securities without taking the risk themselves. We're all familiar with marketplaces like T0 and Open Finance and Archex, but there's actually a full-on exchanges trading like Merge and others being developed around the world.
Yeah, we've got a full list of well over 80, and that we continue to update, and we're going to be fully revamping that. In addition to that, it's really growing like crazy. It's hard to keep track.
Yeah, and then the market is jumping in and to try and meet this anticipated surge of just digital securities, right? So they'll eventually trade on these markets and exchanges. So because they are already operating markets or developing technologies to make operating marketplaces more efficient, investors will aggregate through these mediums of exchange, and then of course that's where they'll trade their securities for the best price, given they are typically the most active at filling orders there. So since security tokens are far easier to support from a technical and administrative perspective, it's expected that a lot of these illiquid assets and securities will leverage these mini stock exchanges of the future, which have superior benefits to Wall Street from a technological and an accessibility perspective. So this strategy tends to be simply, identify a marketplace and a place to list to token there, and then from there, the strategy could evolve maybe to even list on multiple markets to support even further liquidity.
Yeah, no doubt that this is the biggest channel, despite the other two layers being disruptive as new formats of liquidity. But I mean, these are certainly the biggest ones.
So I have to agree with you there for sure. But there is the remaining, question around a potential fourth layer or option, right?
What layer is that? I think I suspect what you're talking about. Jump into it.
Well, as you mentioned, that article was written back in the beginning of 2019, which is a time where the concept of DeFi, decentralized finance, was still in its infancy. So like the year 2016, I'd say, for anyone who was involved in ICOs. Therefore, security tokens, they were definitely not considering solutions like Uniswap to create decentralized automated market maker pools for securities like we've now seen with Realty or Mount Pelerin. So did you guess that correctly there, Kyle?
Yeah. DeFi is absolutely a new phenomenon and an innovation, and it's hard to anticipate what it all still means yet, but early applications and uses are being tested and working incredibly successfully. You can even use security tokens to borrow or stake now, which is fascinating.
Right. So this space moves so fast. Who knows what the future is holding next for us? But where would you put DeFi platforms in the current 3 layers of liquidity, Kyle? Or would you make it a 4th layer? Is it issuer managed or is it peer to peer since it's decentralized?
Yeah, it's definitely a very nuanced answer because the decentralized exchanges of early 2021 may be very different from the DEXs that we see in the future. I think when we consider a platform like Uniswap, which is the best current example, it offers no compliance mechanisms or regulatory standards and requires that the issuer manages that whitelist themselves, which shows that it has many qualities that make it seem like a tech solution for issuer managed liquidity. Essentially, you could look at it like it's a platform to make the issuer managed process easier and more scalable, especially as it's free for any issuer to use. The one caveat with that answer is that the automated market making component, which incentivizes other investors to stake their shares of the asset to provide liquidity for the market while earning fees on each trade. These fees are governed by the community through a governance token, which then starts to make it feel like it should be classified as a liquidity solution outside the issuer's direct control, as the fees and the decisions of the platform could change over time without the approval of the issuer of those listed assets. So I personally think that the classification of what stage a liquidity option should be will depend on the investor and where they're sourced from. So if you look at it from that perspective, in an issuer managed solution, all the investors are directly sourced, serviced, and managed by the issuer themselves. In a peer-to-peer solution, the issuer may not service each trade, but the transactions are still intimate between investors who know each other. And then in the exchange model, the investors don't know each other, and as long as the other side fills the requested buy or sell orders, they frankly don't really care. So at the end of the day, a decentralized exchange falls into that category if we're considering it from an investor's perspective. And if I had to pick a classification, I'd probably go with that one. But you also finally could make the case that it should be totally separate from centralized exchanges, as the permissionless features of a decentralized exchange in combination with the democratized price discovery and the liquidity features are a significant differentiator from the traditional solutions. But I just don't know if those solutions have been developed and fleshed out enough yet to warrant that separate classification yet. But who knows? Maybe in the next few years, as we see innovations on these models, which we absolutely will, it may be a topic to revisit.
Indeed, it's hard to say for certain since most secondary markets are managed by some sort of centralized party at this point. But that's all I've got. I think about the layers of liquidity for security tokens and I guess assets overall, I suppose.
Well, thanks for breaking it all down, Herwig, and then I think that's all we got for us on the show today. So thanks again for listening, everybody that's stuck around with us through this whole episode, and be sure to catch us every Tuesday when we release a new episode of the Security Token Show. And again, join us, our first ever Clubhouse breakdown. You don't want to miss it. Thursdays, 5 p.m. Eastern Time. You can come see what special guests have to say about the podcast and maybe ask some questions of your own.
If you're not on the Clubhouse app yet, and if you have any questions about any of this, please feel free to reach out to us on LinkedIn or Twitter as well. And be sure to engage with the community at stomarket.com, where you can see all the latest security token pricing data. And it's also where you can submit security token news, events, STOs, and a whole lot more. So thanks for listening, and I hope to catch you next week on Tuesday.